2023 has seen some fairly hefty gains across many global stock indices and indeed record highs for the Dow and the DAX as well, but it's driven in part by some fairly hefty moves on some individual stocks such as the likes of Nvidia, Microsoft and some of the other big players like Apple. But at the same time, we've seen the dollar pull back from the highs we saw over in midsummer. We've seen US 10-year Treasury yields now hit levels not seen since June on the way down on expectations. The next move by the Fed is to cut interest rates at some point. But the big question is can they avoid recession? Well, let's take a look now in some more detail about what the year's given us in terms of detail and how we can look out to 2024. I'm joined now by IG analysts Chris Beauchamp and Axel Rudolph, and from Daily FX, it's Nick Cawley and Richard Snow. It's good to be able to catch up with you all in what is now becoming a regular annual event. But Chris, as the chief market analyst at IG, I'd like to pick on you first and ask you the question about what we've seen last year and what we can learn taking us into 2024.
2023 was the year that caught everybody by surprise. You couldn't move a year ago for recession forecasts, that the Fed would have to keep tightening rates, the US economy would weaken, that we'd see new lows in stock markets throughout the year. And yet here we sit as mid-December, we've got the Dow at record highs, we've got other indices doing very well, not entirely, China suffering quite a lot, but it really has caught people on the hop. And in the last week or so, we've had the Fed pivoting. Now, the Fed pivot that everyone's been looking for. And finally, the Fed has said, actually, rates won't stay as high as we thought for as long. And they'll start to come down. So it was the year of surprise. It really caught everybody, I think, by surprise. And that's probably the lesson we should take away from the year, is always try and keep an open mind when you're entering a new year, and try and sort of be open to what might happen during the course of the next 12 months.
Let's switch to focus on as well to some of the successes we've had last year and some of the surprise trades. Axel, you cover many of the trade ideas that IG produces. Anything last year that strikes you either as a surprise or some successful trades that have come out of 2023?
Well, as Chris just said, quite a few markets, especially equity markets. I mean, the Nasdaq being up over 50% year to date is quite incredible. Nobody expected that to happen. But even the S&P nearly up 20%. The DAX, as you just said, in new all-time record highs. The Dow in new all-time record highs, all of which wasn't really expected at all. And we were well positioned with regards to trade of the week and trading the trend, where we went basically long equity markets in Europe and in the US at the end of October, beginning of November. But we also had other trades on were interesting, such as orange juice futures. They rose by over 100%, which wasn't expected either. And at some stage also sugar, for example, rising by 40% or so before falling back again. So there were lots of surprises last year. Yes, definitely.
And Nick and Rich, let's bring you in to take a look in some more detail about what's been happening across the desk at Daily FX. Our specialism, obviously, within the foreign exchange markets. Nick, what's your takeaway from 2023?
Yeah, I kind of agree with what Chris was saying about it being slightly surprising. I think one of the notable things that I've seen is that there was a constant battle, I think, through sort of H2 between the market's perception of where rates were going to go and the messaging coming from the Fed. And the Fed was very strident in saying that it wasn't going to cut rates and et cetera, et cetera. But whereas the market kept on testing the Fed by if you look at the sort of Fed fund futures and expectations, they were starting to price in cuts, rate cuts, back in sort of August, September. So I think that there were signals that the Fed was going to have to move. And as I said, I think the main thing was the battle between the markets and the central bank, which is always interesting to watch.
Yeah, and Rich, I mean, just bringing up the final comment from the FX markets, it's interesting, isn't it, to look at what's been happening more recently as well with central banks and their moves to try and calm down the fears that have been that interest rates were going to continue to rise. What's your thought going into the back end of 2023 as we prepare to look out to 2024 for your view on things?
Yeah, I think, look, a lot of the times it's focused on the dollar. We look at the dollar for a number of other Forex pairs as to where those are likely to end up. And right now we're seeing the dollar really coming under pressure. Of course, Chris mentioned the dovish Fed coming in and talking about rate cuts. So I think a lot of markets will get a bit of reprieve now that the dollar appears to be on a downward trend, and that's sort of where we are looking to close out 2023 and where we forecast 2024 to pick up straight from there.
So how do you look at 2024 then, Rich, in terms of where we go from here, and how do you pick up the ball in the new year? What is it you're looking at that's going to give you an opportunity in the market?
Yeah, I think whenever you're trying to look at the foreign exchange market and really try and pick a pair that could stand the test of time, I mean, obviously looking at entire year, it's a very long time to look ahead, but I would say at least for the first half of next year, if you were to position yourself in a way where you analyze a currency that's perhaps looking a bit weak and pair it against one that's perhaps on the up, you would look no further than dollar yen. I think there's been quite a lot of speculation about a potential policy pivot from the Bank of Japan, but I think more urgently we've been seeing a change in fundamentals. We've seen lower oil prices helping the trade balance for Japan, obviously a net importer of oil. And we're also seeing a narrowing of yield differentials between Japan and the US, which is really helping to motivate a bearish move on the side of dollar yen.
Actually, it's interesting, Nick, as well, picking up on that point from Rich there. I noticed in amongst some of your notes, you're talking there about this narrowing rate differentials between the front and the back end of the US yield curve as well. What's that telling you as well about where we go in terms of our outlook for 2024?
Yeah, I mean, we've had this inverted 2s, 10s, US Treasury 2-year, 10-year curve for some time now, which was really, pointing everybody down the road of a recession. As the fears of recession are being smoothed anyhow, or being taken away, you can see that I think the front end of the curve, the 2 years, are going to go down further. I can see the 10 years going down a little bit, the yields on the 10 years going down a little bit, but not as much. And so what I think you'll do is you'll get a positive yield curve where you get more bang for your buck on the 10-year than you do on the 2-year. And I think this will just be a way of showing that the market, that the economy is mending, and as I said, recession fears are being just pushed to the side of it.
Yeah, and Chris, what's this mean for stocks for next year if we're looking at this repair underway now? I can't help but think that we've still got some really big events overshadowing us. Of course, geopolitics just hasn't gone away. In fact, it's got worse. We've got a big debt pile, which is causing all sorts of problems for corporates and individuals at the same time. Interest rates, whilst they might come down, are not coming down as fast as some had hoped. But how does the layout look for the stock markets for the beginning of 2024?
Yeah, there are plenty of hurdles, but then there always are. I suppose you do have, as everyone's been saying, the largest number of elections in 1 year. I think in at least recent history, if not all of history, something like 40% of global GDP goes to the polls really next year, which does provide potential for volatility. We usually see volatility spike in election years. If you think back to 2016 and 2020, there are other things going on in 2020, but those are also volatile years. So it is important to bear in mind that when we say that maybe the outlook is brighter than it has been for a while, that's not to say you won't see volatility. And I think just as at the end of last year, everyone thought a recession was coming, and you should just be aware, and everyone thinks the same thing. Now, when a lot of people say, okay, there won't be a recession, there will be a soft landing, at the moment, that looks like a reasonable bet to make, but there should always be that caution that maybe we don't get the soft landing. Maybe the Fed does stumble, maybe inflation surges again. That's perhaps the big risk, as well as the big events of the year. And yes, the geopolitical elements have provided the reasons for some spikes in inflation over the course of the past 18 months. That's a risk to bear in mind. And I think with the VIX at such a low level, we have to be prepared for these corrections. You look at how far stocks have come in the space of the past 8 weeks. By any measure, that means we should be expecting some kind of pullback within at least the first 3 or 4 months or so. We don't know how far it will go, or when it will arrive. But certainly to expect a smooth ride higher from here would, I think, be just as dangerous as everyone coming into the end of last year expecting a recession to arrive.
Yeah, Axel, what's your thought from a technical point of view? As we've said, DAX record high, Dow record high, S&P 500 not too far away, NASDAQ ditto, albeit the fact that it is really just a small handful of stocks that are driving this march higher. From a technical point of view on the indices, what are you thinking in where we go?
Well, when you have an exponential rise, as we've seen since the end of October, then that is sort of bubble territory, really. And it may well continue for several more weeks. But I wouldn't be surprised once the S&P 500 does make a new all-time high, which I believe it might well do in the first quarter of next year, and perhaps rise towards the psychological 5,000 mark, then you could at some stage correct lower again and perhaps come back towards the sort of highs we saw in November this year. So it's not going to be one straight line, as Chris has said, because we have all of these outliers out there, and possibly new ones which we don't even know about yet. There's always a surprise in the market at some stage. And it could be something as little as, for example, rate cut expectations, which have now moved forward to March of next year, being pushed back to May or June. And that alone could perhaps lead to no more buyers entering this very steep uptrend, and therefore us seeing a correction.
And Chris, there's been this underperformance, hasn't it, for the FTSE 100, something I know that you will have been monitoring throughout the year, because we spoke about this time last year about the prospects for what was likely to happen in the London markets. And I think there's been this underperformance. The FTSE has been one of the poorest performing of the major indices. It is up, but only by a small margin when you compare the 20% gains we've seen in some of the other markets. Now, why is it that we've seen this underperformance, first of all? And what can we learn? And is some of that going to be unwound, giving us a better year next year, do you think, in London?
It's partly because the FTSE doesn't have those big attractive tech stocks, which is a problem it's had for years, really. As you say, the gains have been driven not entirely down to the big seven tech stocks, but in no small part they have led the way. They're like the generals of the market rally, and without those on the index, you just don't see the big gains that you get in places like the Nasdaq. Now, the year started so well for the FTSE 100. We were up at 8,000. It seemed like the index was finally blossoming, and here we are, about 400 points lower from that, and as you say, barely up for the year. Maybe the way to play it this year is, yes, it's cheaper than everyone else. That does allow for some upside in terms of valuation, people buying it because it looks more attractive on that basis. What you are missing for the FTSE, as has been shown all through the year, is the institutional flows. Fund managers across the globe don't seem to like UK equities for maybe uncertainty reasons about the economy or the direction of politics. Got the UK election this year as well. So until you get those big institutional flows, there's not much that can drive the FTSE 100 high. Its best hope is that we miss a global recession, that growth rebounds, and that things like oil and mining stocks see more demand, and thus they see their earnings improve. And that would be a big help, I think, really, for the FTSE 100. But certainly the year that could have been has turned into, once again, unsurprisingly, a disappointing year for the FTSE 100.
Nick, looking at some of the alternatives, I know you've been doing some work around the crypto space and Coinbase. It's an interesting one, isn't it? We're still awaiting, I think, full details of any ETF that's going to be covering this market. But it certainly seems like there's been a little bit of an uptick in some of the interest around cryptos. Anything worth mentioning going into next year, or is this something that we should still be very wary of as a market?
Yeah, I mean, the crypto space you should always be wary of. I mean, it's one of those ones that's just got volatility spike around the corner. I think the two main things, especially going into the first quarter of next year, is that these potential spot Bitcoin ETFs. So I think there's 12 applications sort of sitting on the SEC's desk at the moment. If one of those gets approved, and there's talk that they will be approved, then it's likely that all of them will be approved. So no one sort of market gets a particular, or no one company gets a particular first mover's advantage. And then, of course, in early to mid-April, we've got the next Bitcoin halving, when they sort of reduce the mining rewards by 50%. These events are going to drive a great deal of activity and volume and volatility into the cryptocurrency space. And I think one way of looking at this, without actually having direct exposure or having to hold a coin digitally yourself, is to use an equity like Coinbase. I mean, MicroStrategy is also another one, but I think Coinbase is one of those equities. It's the largest US cryptocurrency exchange. It's SEC regulated. It's not like one of these unregulated exchanges which sort of close down every now and again. It's there. It's on the big board. It's quoted on the stock exchange. They're custodians for most of these spot Bitcoin ETFs. They'll benefit from any pickup in market volume. I mean, the stock has already seen a very decent rise so far this year, and I think it's one to look for if you believe in the cryptocurrency story.
Yeah, of course, that's all about belief, isn't it? And your thoughts and how exposed you are, and indeed your appreciation of the volatility. Rich, just very quickly talking about alternative markets or other markets I should really want to talk about, and that's gold. It's been said in part that some interest in gold has been stolen by cryptos, but nonetheless, we see a record high that we've seen just in the last couple of weeks on the back of a weaker dollar. What are your thoughts on gold as we look out to next year?
Yeah, gold's an interesting one. I think the underlying drivers for gold are there. They're sort of stacking up. You look at a weaker dollar, you look at declining US yields, and the fact that, gold has been very reactionary in 2023 to some of these external threats that have come through. We've seen a lot of volatility, a lot of movement towards the upside. And of course, gold is your safe haven. It has a lot of safe haven appeal. So I think going into 2024, although we've seen quite a big move to the upside towards the latter stages of this year, I do think that, with the ebbs and flows of the market, you could perhaps look at getting back into that longer trend throughout 2024 as those interest rate expectations continue to move lower.
And just very briefly, oil, same question about next year. We've seen 6-month lows as we begin to start the final hurdle, or the final mile, I should say, for December. There's obviously concerns about recession risk out there, which is dampening down some of the expectations about oil demand as we look out from this point on. What are your thoughts for oil? Pick up or drop off next year? Where are we going? Or is it just a question of wait and see what happens?
It's a very tricky one. I think, as you mentioned, it'll be highly dependent on the global economy. If we see a pickup in China, of course, they've rolled out some stimulus more recently, and the market's taken quite kindly to that. So we'll have to wait and see if we do get a proper recovery from China. You typically see demand growth coming predominantly from China as far as the oil market is concerned. So yeah, it just depends. I mean, we've got economic forecasts into next year where we're considering moderate to low GDP growth. So it really just is a matter of how will the economy unfold. We'll get a good idea of how that plays out in Q1. And then it just comes down to demand and supply. We've seen the US increasing supply. OPEC are no longer presenting a unified position. We have some fractures there. So I think some of that negative PR has filtered in, that negative sentiment essentially towards the end of 2023. And I do think we'll see oil prices stabilize somewhat in 2024. Of course, you can't rule out further voluntary cuts to come through. So I do see perhaps another move up, perhaps $10 by the end of the year.
Yeah. Okay. Chris, just one final brief comment. We haven't mentioned the geographies in any great way in the last 15 minutes, but just wanted to quickly catch up on China. This time last year, there was mention made in our call about the Chinese economy. And at that point, we were still expecting the Chinese economy or the authorities to relax the COVID lockdowns. That came, but the growth didn't. Surprising many, and China has really been a big disappointment this year. Is it going to be a change of pattern next year, or is it going to be difficult, and are we going to see deflation in the Chinese economy that could now dog any recovery there?
Yeah, it's a really tough call. And again, it's a classic one of people expecting something to happen and it doesn't. And a lot of it is outflows. Institutional investors, again, taking money out of China because the performance just isn't there, because of broader concerns now. Reopening faded very quickly, and then you get the slowdown. And I think when you look at charts like the Hang Seng, you think, they've gone down a lot, they must therefore start to rebound. Things can go a lot lower. I think at the moment, there just isn't that catalyst for a longer term turnaround. Everyone hopes for that stimulus in the Chinese government. That doesn't seem to be arriving yet. And so I think you'll get another false dawn in Hang Seng probably fairly soon. But you wouldn't be surprised if that then turns into another downturn, and maybe we go back as far as those lows from this time a year ago. So really a tough time for Chinese markets still ahead.
Okay, that's great. Thanks so much indeed for your time, gentlemen. We've been beaten by the clock, and we've got to wrap it up. But thanks indeed to Chris Beauchamp, IG's Chief Market Analyst, to Axel Rudolph, Nick Cawley, and also Richard Snow from Daily FX. Thank you much indeed. Enjoy your holiday, and we'll see you in the new year.